Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play. And today's webinar is titled Getting Started with Options. It's understanding calls and puts, just in general, the vernacular that's behind the options marketplace, and we'll give you the fundamentals if you'd like to start trading options. Now, very basic seminar, we're going to talk about buying puts, buying calls, rights and obligations that are involved with trading options, and the entire event will last about 1 hour. We're going to do about a 45-minute presentation using a PowerPoint, and then at the very end we're going to open it up for questions. If you have any questions, please use the Q&A box. It is on the bottom of your screen. You should see a little question mark. That's the Q&A box. That's open for everybody that is participating in the event, and we'll try to address any questions that you may ask during the show. It's a live event. We'd love to have as much audience participation as possible. So getting started with options, understanding calls and puts. So before we get too far along though, we do have a disclaimer that there will be some real securities that we'll be looking at today, in particular Apple stock, and the quotes are a little bit dated because we're just looking at specific examples. Nothing's meant to be a recommendation, and I just need to give you that disclaimer. And if you're going to trade options, you want to read the characteristics and risks of standardized options available through your brokerage firm or by clicking a link or going online and looking it up. But everybody should read that document before they begin trading options. So here's our agenda for today. We're going to review the basics of calls and puts. It's really about the vernacular that goes along with it. What is an option contract? When we get a quote, what does that actually tell us about that option? We're going to look at some option chains inside the First Trade platform, and then we're going to get long and short equity calls and talk about getting long or short equity puts, and then we're going to put it all together and then answer some of any questions that you may have at the end of the show. So to start off with, we're going to say, what is an option? And when I look at basic option strategies, one of the biggest things that I see a lot of people that come to the event, they come with the attitude that we're going to learn how to speculate with options and the get rich quick scenario by using the leverage inside the option contract. Now, the biggest thing to note here is that that's not where options came from. Options came from a need to protect an underlying asset. In our instance today, we're really going to just talk about stock options. But, back in the day, there was agricultural. One of the first instances options were ever used was actually by the Dutch aristocracy way back in the 16th century, around tulip bulbs, if you will. But so options have been around for a very long time, but listed option contracts, where the marketplace really took off, didn't really happen until about 1973, not about, when the Chicago Board Option Exchange opened up its doors and first started trading listed options. But what's the biggest thing to note about options is that they are a contract, and that contract is usually written by the seller, and that seller will take on an obligation. And so we're going to go through the terms and conditions of the option contract, and you're going to find out there's a lot of synergies between the options trading world and the actual insurance world as far as the terms that are used between the two industries. So what is an option? Well, it flat out is a contract. It's a contract between a buyer and the seller. The buyer pays a premium. For that premium, they get a right. The seller receives that premium, and for that premium, they take on an obligation. They can be issued as calls, or they can be issued as put. Calls contain the right to buy, where the put contains the right to sell. So in this instance, if you think about it, a lot of people get a little bit confused by the term call or put, and where that term actually comes from is from the sell side of things. If I sell a call option and you are the buyer of that contract, you get that right, and your right is to call stock away from somebody. And hence that's where the term call comes from. And if you buy and it's a put, then you get a right. I sell it to you. I take on an obligation, but you have the right to put stock to me. And that means you're going to be selling stock to me in that instance. So that's where the terms come again from. And once again, you've got to think about it from the sell side of the marketplace if you really want to get a good handle on option trading and what option trading is all about. So the anatomy of an option contract in general, and we're going to start off with call options here, is what are we agreeing on? So we come to the back before the Chicago Board Option Exchange started trading options and had listed options on the trading floor. There literally used to be option contracts that were drawn up. I wrote the chapter for the Chicago Board Option Exchange on the history of the options marketplace. And there are actual contracts that used to get published in the newspaper, and that's really the start of where the quote page came from. So here's the contract. What are we agreeing on? We have to decide that. Then what product are we agreeing on? And what price are we agreeing on? What is the cost of this option contract? And then obviously, as with all contracts, there's usually an expiration date. And so you got to come up with the time frame. So in our instance, we're going to talk about the contract amount to start with. And 99% of the time, the option contract is going to represent 100 shares of the underlying stock. There may be instances basically about what might happen with a stock that already has a contract. In other words, there could be a merger, there could be a stock split, if you will. And that could screw up the amount that the quantity of the option contract. But all option contracts start as 100 shares, and that's just the way that they're written up. So the quantity is 100 shares of the underlying stock. What is the product that we're agreeing on? Well, whatever that stock is. In our instance, we're just going to talk about a generic stock, ABC, and we're going to focus on stock options. But you can buy options on exchange-traded products, ETPs, otherwise better known as exchange-traded funds, like the SPY, like the XLE, which is the spider that tracks the energy. So there are a lot of different underlyings that you can trade an option contract on. We're going to focus on stock today, like I said, but just be aware that it's a contract. Whatever you can write up a contract on, you can trade options on. That's straightforward. What is the agreed price that we're going to be making this transaction on? So if you're the buyer of the contract, you get a right. That right is going to be to buy or sell the underlying stock at that strike price. So this would be the price per share, and it's written right into the contract, obviously very important. And then time frame. Time is money. The further you go out in time, the more it's going to cost you, right? As far as the option contract is concerned. I'd rather have my right if I'm buying that option contract for a longer time period than a shorter time period. But the longer I go, the more it's going to cost. Now, in the options trading world, man, this is, back in the day, it was really straightforward. There was only one day of the month that option contracts expired, and it was the third Friday of the month. It was very straightforward. Nowadays, though, there are many different expirations. But when we're talking about stock options, like we're going to focus on today, normally the expiration date is on a Friday. So some index options, which we highlight here, right here in the slide, will expire on Monday, Tuesday, or Wednesday of the week, but most stock options expire on a Friday. All right, so in our instance, in our example that we're going to go through, we're going to talk about one option contract. Underlying stock is going to be a fake stock called ABC. The price that we're going to look at, the strike price to buy or sell the underlying, we're going to talk about a call option. So we're going to have the right to call stock away at is going to be at 100. And the time frame that we're looking at now, these aren't exact. These slides were put together at a different point in time, but it's fairly close. We're looking at a March 15th expiration. That would be a Friday in March, back when the slides were put together, and that's 36 days away. And that's what we really need to focus on, is that DTE stands for days to expiration, and we're 36 days out. All right, so if I think about this contract, and if you didn't have the exchange that makes it very simple to trade these contracts, you would actually negotiate all the terms and conditions. So you'd say, all right, are we talking about a call or are we talking about a put? Do you want the right to sell the stock or do you want the right to buy the stock? So first of all, we come up with that negotiation. And then there are three different things that we can do. Is we can exercise. If we do that, that means we're going to be buying 100 shares of the underlying stock, or selling, depending on if it's a call or a put. We can let it expire. Sometimes based off of the strike price, in this instance, we're talking about $100 a share. Well, I don't want to buy the underlying if on the marketplace it's trading below $100 a share, right? Say the market on ABC stock is at $95. Why would I exercise my right and buy it at 100 when I can buy it in the actual marketplace at 95? So in that instance, they would expire. And the last thing is you can actually trade out of it. So if I set up my call option on ABC stock and I buy a call at 100, I have 36 days to expiration. I can exercise and buy the stock. I can let that right that I own expire, or I can trade out of it in that instance. And then we got to come up with the price or the premium for that option contract. So then you agree upon the price and then you would trade it. Now, all of this is summarized in a quote. When you look at an option contract, before you would negotiate all of these things, and the strike price could be weird, the number of shares might be weird, but now in the listed options marketplace, they wanted to put make it very simple and very straightforward. And when you look at a quote for an option, you're actually looking at an actual contract, but everything has already been set up for you. There's no negotiation. Either you buy it or you don't, or you could sell it if you'd like to. It's very straightforward in the options marketplace. So here's the general rules as far as put options are, or as far as option contracts are concerned. These are the four basic trades. No matter if you're doing a vertical call spread or a butterfly trade or any of these fancy strategies, they gotta come from these four basic option trades. They could be some combination of them. We're gonna just focus on really just buying calls and buying puts today. We'll look at some short contracts too. But in general, if I buy a call, I have the right to buy the underlying stock, right? So I own that right all the way out until that expiration date. If I have the right to buy, that means I'm obviously bullish. This is the most straightforward strategy, I guess, in the options trading world. Now, on the other side of the coin, if I want to get bullish, I could actually sell a put. And if I sell a put, that means that I will take on the obligation, once again, to buy stock at that strike price. So in this instance, if I sell that put, I actually bring in premium, but the stock could be put to me. So that means I could be forced to buy the stock at that strike price. I receive that premium. I want the market to go up. If you're going to force me to buy that stock at a price above where the marketplace is at, I'd rather have the marketplace go up and then I can collect my premium. So these are two strategies that are bullish. And then on the other side of things, we're looking at short calls and long puts. Those are both bearish strategies. If I don't buy this call and I sell it, well, obviously, if I buy, I'm bullish. If I sell, I'm bearish, right? I want the market to go down in that instance. I take on an obligation to sell the underlying stock, and I get paid a premium for doing that. If I buy a put, well, if I buy that put, that's a right to sell. So that means I want the market to go down, because I want the market to go down so that I can buy the stock at a lower price and exercise and sell at a higher price. So if I buy a put, I'm also bearish. I pay premium. I get that right. That right is to sell the underlying stock. All right. So if we look at just the option chains inside the first trade platform, this is a little bit dated. Like I said, Apple right now is at 235 is where the underlying stock is. Markets are live, rocking and rolling. This shows the stock at 189, but everything else is fairly just straightforward as far as option chains are concerned. This is your friend if you want to trade options. Option chains are well, it shows you all the potential contracts in the options trading world, all in one little simple page. So to start with, if you look on the left side, and this is standard with most brokerage firms, you'll have the left side is representative of calls, and the right side will be representative of puts. But right now, we're going to kind of focus on call options, and then we'll talk about the other things that are part of the option contract. On the right side, we have the puts in this instance. So it's highlighted here by calls and by puts. And then if we look in the middle, that's the strike price. So for the stock is at 189. Let's talk about the 190 strike. You have the call option if you would like to, and you could buy that call option and get the right to buy the stock at 190. Or you could buy the put option and have the right to sell the stock at 190. By looking at the chain, you're going to see here is the marketplace for both of these option contracts. You decide, do you want to buy a call and be bullish? Do you want to buy a put and be bearish? Then you have different expirations. There's a plethora of different expirations to choose from. In this instance, we have the February 9th expiration based off of where this was at. You had 1 day remaining to that expiration date. But you also have let's go back one. You also have February 16th, February 23rd. As you know, most of these are Fridays as far as the calendar is concerned. March 15th, March 22nd. You decide how long you want that option contract to live. Now, if I look at a quote, the last trade on the option contract is where the last negotiated contract traded at. And you'll see by looking at that, that is the price. So last time that this option contract traded on the call side, the 190, it traded for $1.14. The change on the last trade, just like on an underlying stock, was up 1 cent on the trade. But most important in the options trading world is to look at the bid and the ask. And I'll highlight both of these, and we'll go back and forth between the two. Okay, so in the options trading marketplace, as compared to the underlying stock, especially in something like Apple, you have, when you get a quote on the stock, you see this is the symbol for Apple, this is the last price, this is the change. The stock is up 51 cents on the day, and you hear that all the time. But if you look at the bid and ask, it's a very tight market. You could sell the market, you could sell Apple, you could sell shares of stock at 189.81, and you can buy it at 189.82. So it's 1 cent wide. That's a very good, very liquid market. You only have to pay a penny difference. In the options trading world, in Apple, it's fairly good, but you'll see some of the markets are a little bit wider than a penny, right? The 190 strike call that we're focusing on is 113 by 115. So same thing as at the underlying stock. The asking price, if you came to the marketplace and said, I want to buy at market, the quoted price is 115, you would expect to get a fill close to 115, but on a market order, anything can happen, but that's where the quoted price is on the market. And if you came to the marketplace and said, I want to sell, well, the bid price is 113 on that option contract. So there's a 2 cent wide market, which, and considering the price of the underlying stock, it's a little bit wider than trading the stock. So that's a very important thing to note, but you have a plethora of different options to choose from, and you want to be aware of the fact that the difference between the bid ask is a lot different, can be a lot different in the options trading world as opposed to the stock trading world. All right, so now you have volume, and volume and what's called open interest or interest in the option contract. These are totally different compared to the underlying stock. This is the total shares that have traded in Apple when this screenshot was taken. But if you look at the volume, every contract that trades, it's 100 shares of stock. So ideally, if you want to get the total number of shares that it's trading, you'd want to multiply it by 100. But what you'll note is if you look at open interest, this is a number that you don't see in the underlying stock. And what it really means is an option is a contract. You can quote the option contract all you want, 113 by 115, but if nobody buys it and nobody sells it, does the contract really exist, right? It's a negotiated contract. It is, you've got a buyer and you got a seller for everyone that does the option contract. And you'll note that in this option chain dealing with the calls, there are a lot more people that have negotiated the 190 strike contract at 40,501 versus the 177.50 strike contract, which is 327. All right. So where does this number come from? Well, and I'll focus on that. Let me just move that slide over one. Open interest basically looks at what all the volume was from yesterday. And when you trade options, you're going to mark it as I'm buying to open the position or I'm selling to open the position, because I can sell an option contract very easily without owning it. And we've kind of showed you that a little bit. And we'll talk about some of those strategies a little bit later. But if I'm closing my option contract and I'm trading that position, I would say, okay, I want to buy to open the 190 strike call for $1.15 times 100 shares, which is $115. And now the market has gone up, let's say, we're correct on our forecast, and I can sell it higher. I'm going to sell to close my position and remove that position from my account. And so every order that gets entered into the trading floor is marked as sell to open, buy to open, or sell to close or buy to close, depending on how you get into it. So the exchange will look at the volume, come back tomorrow, and adjust the open interest based off of how many positions were closing positions and how many positions were opening positions. So if you look at this and you see this volume, see that 3 contracts traded on this option contract, this 177.50 strike call, but there are 327 contracts that have been negotiated, that are out there, that are live, and for everybody that bought one, there's somebody that sold one. So that really represents 2 different parties, or 2 different contracts, I should say. Somebody could own all of them, I guess, at that point in time. But there's a buyer and there's a seller of the contract, and that is what the interest is, if you will, in that one strike price. Okay, so based off of all of this, let's now get into what it actually means to buy a call option. So in our equity call option scenario here, we're going to buy to open one, and XYZ is a fictitious stock, in this instance, call option, that expires on March 15th at the strike of 150 for $7. So the owner has the right to buy 100 shares of XYZ at 150, $150 per share, anytime up until that March 15th expiration, which is 35 days away. That's where we started at. And in exchange for that, they're going to pay $7, or it represents 100 shares, or $700. So the max risk in this trade is $7, and $7 the total cost of it. So in this instance, if you notice here on the x-axis, that right at $7, that's your maximum risk on the trade. Now, if you bought the underlying stock, you would have from 150 all the way down to 0, right? If you bought 100 shares of stock. But now we have limited and known risk. Now, the downside is that you need to pay for that option contract. And that means that you need the underlying stock to reach the break even. You take 150 plus $7, or the stock needs to get to 157 in order for this to break even. And from that point on, you have unlimited upside potential. Max gain, you have unlimited upside potential when the stock moves above that break even at 150 in this instance. Now, if you sell the call option, it's the exact opposite. You take on an obligation, but you have unlimited risk. This is one of the riskiest trades that you can do in the options trading world. And I'm just going to introduce it to you and talk about the break evens and everything that's involved with it. But if we think about selling option contracts, very rarely as a beginning option trader are you going to just sell to open an option contract without adjusting it or giving yourself some protection. But to start with, let's look at what selling an option contract entails. We're going to sell to open one, XYZ call, same expiration date, same strike, same price. So I'm on the other side of the coin. Somebody came down and said they wanted to buy. I'm going to sell it to them. Now my max risk above 157, which is our strike price. If the stock continues on up, I'm short the call option. I can get that stock called away from me at the 150 strike. So from that on up, I have unlimited loss potential as the stock goes up and up and up. Below 157, below that price, I'm okay. I'm okay with the trade. And I get paid a lot of premium, a lot of time value for saying that I will take on that obligation. Now from 150 on down, all right, I can't make any more. As opposed to going back to this one, I have unlimited upside. On this scenario, I have limited and known upside. From 150 on down, I can't make any more than the $7 that I sold this option contract for when I do this. So stock at or below 150 or lower, I have a limited and known amount. I have $7 or $700 for the one contract that I sold in this scenario. Okay, so if I'm looking at, we're going to walk through a couple scenarios where we're going to buy an option contract and we're going to talk about what can happen with the underlying stock. And we're going to look at how the option contract can react to a underlying stock price move and where we need the market to go to before that expiration date for it to be profitable. So we got the long call purchaser and the short call writer. So in this instance, I'm bullish. 165 is my target price. I have a 30-day time frame. In this instance, I'm neutral or bearish because if the market just stays where it's at, I'm okay on the trade too. But I want the market to be below 150 if I can, and I also have a 30-day time period. So now we're going to walk through, here's where our break even is at, here's where the stock price is at, and we're going to look at the time frame to that expiration date, and we're going to move the stock. All right. So in this instance, XYZ trades at 165. We're correct at our forecast. We're going to sell to close the 115 March strike call. We receive $17 for this. So in this instance, if we do hit that 165 strike, we have a lot of leverage, a lot of gain in that position. A gain of $10 per share. We paid $7 for it. We're at the expiration date. The stock hits our target of 165. We're up $1,000 on the position for every single contract that we bought. Now, on the writer side of things, on the seller of the option contract, which is also referred to as the writer, and I didn't really say that to start with, but once again, that comes from the insurance world. If you buy an insurance policy, a lot of times the company that sells you that policy is considered to be the writer of the policy, or otherwise referred to as an underwriter of the contract. And once again, that's where the synergies come back to the options trading world. There are a lot of times the short call person that sells the call is referred to as the writer of the contract, taking on an obligation and getting paid a premium for that. So in this instance, the call seller would be down and the call buyer would be up. Now, let's say that XYZ traded at 160 166 after the trade was placed. So now the premium received is $16, and the gain is only $9, and the loss is only $9 on the call side of things. But the underlying stock, the trade is placed, 30-day time frame. We came up. We didn't quite get to our upside target. So in this instance, we don't quite make as much, but all the time premium would erode in the option contract, and we would still be trading for what the intrinsic value is if we hit the 166 market. Let's say that we place the trade and now the underlying stock has gone to day 15. We still have 15 days remaining to expiration. And if we look at our call option, it's now trading for $5. We need it to get to 157 in order for us to break even. So in this instance, the premium received is $5. Our loss is $2 on the trade. And on our call side of things, we actually received $2 because we received $7 to start with, but the call option is trading for $5. So now we're down $2 on the position, and the short call writer is actually making the money on the trade. So we made the move up, but we didn't quite get to our target price, and we have time decay that is eroding on our option contract. So it's always important to realize that if you buy options, not only do you have to be right on the direction, you also have to be right on the timing. All right, so now let's say we did the trade 165 target. You have a 30-day time frame. We put it on XYZ. Stock was at 150, and now the underlying stock goes down, and we're at the expiration date, and it's trading at 145. This is where the leverage factor comes in. If I'm buying this option contract and the market is below 150 at the expiration date, then we'll see that the max loss on the trade is the premium that we paid for it. But the underlying stock was at 150. If we bought the underlying stock outright and the stock was down 5, we'd be down $500 on the stock. But in the options contract, we're going to be loss of the premium in this instance, which is $7. So if you're thinking about buying options and your first time buying option contracts, if I'm buying 100 shares of stock and I want to buy this option contract, I want to think about just buying a similar amount of options relative to the number of shares of stock that I would like to trade. If you use the leverage factor and buy as many as you can, well, you have the risk of losing your entire investment. So instead of taking the $15,000, add $15,000 to buy 100 shares of stock and buying as many option contracts as I can, realize that you have a lot of leverage in your option contract, and this can be a concern if you're buying options and the market actually goes down and doesn't match your forecast. And you need to be able to think about what type of leverage you want in your option contract. Now, if you sold that option contract and it expires worthless, you have a gain of $700. So now in this instance, the call writer takes on a lot of risk up front, saying you can call the stock away from me at that 150 level. But if the market goes down, you get to keep all of the premium. And in this instance, you would be up $7 on this trade, or $700. Now, on the put side of things, we're bearish on the market. So we own the right to sell 100 shares of stock. So in this instance, if the stock is 150 or higher, our max risk is the put premium that we paid. We're going to say in this instance, we're paying $7. The break even, we need the market to go down 7 to 143 in this instance, and that's where we break even. And then from that point, we have substantial gain. Beyond the break-even point, all the way down to 0, we could profit on the underlying stock. So by buying this put option, we have the right to sell the stock at the strike price of 150. And that means that if the market continues on down, we have the upside potential all the way down to 0 on the stock. So the concept would be that you could take the stock, let's say it goes down to 20, you could take the stock at 20 and put it to somebody at 150 and sell it. So you'd be buying on the marketplace at the lower price and exercising and selling at the higher price. All right. Now, if you sell a put, I personally like put selling as a strategy in a stock that you wouldn't mind buying. So underlying stock here is at 150. We're going to sell the XYZ put 30 days away, expiring on March 15, at a price of 150 for $7. So in this instance, you're saying, well, if the stock gets put to me, I will buy it at the 150 strike price, and I will receive cash for saying that I'll take on that obligation. So it's not a bad way to buy the underlying stock if that's what you'd want to do. Now, if I do that, my max risk is below 150 minus 7 or 143. That's where our break-even point is going to be at. If the stock moves below that price, just like if I own the stock outright, I'm going to have all the risk all the way down to 0 below the 143. But I do get to keep the premium no matter if it's put to me or not. But my max gain is only if the underlying stock goes above 150 or stays higher on that strike price. So selling put options is an interesting alternative if you like to buy stock. One way to think about this is if you put in a limit order to say, I want to buy the stock at 150. Well, if the stock comes down to 150, you would just buy the stock at that price. Here, if the stock comes down to 150, I'm saying I'll buy the stock, but I actually get paid for saying that I want to buy the stock. And if it goes below 150 by that expiration date, well, then in that instance, I am going to, at that instance, I'm going to be buying the stock at 150 and also get to keep my premium. Now, one of the biggest things about selling options that you need to think of, and a lot of people will say this, well, why would somebody give me that premium for saying that I want to buy it? The marketplace is where the market is where the market is. And if you see something and you want to buy that, or you want to sell that option contract, well, you're going to get that premium and they can't take it away from you. So like if you sold a car to somebody and they drove away, they can't come back and say, oh, here's your car back and I want my cash back, right? As soon as you sell it, it's gone. It's your cash. It's what you can take that cash and do whatever you want with it. And that's the way the options marketplace works too. I sell something, I get that cash now, and I can use that cash however I'd like to use it. So if the market even goes against me, I still get the initial cash. I might have to close out the position. I might have a loss on the position, but the cash in hand is cash in hand in that scenario. All right. So with the equity puts, if we're looking at this, XYZ put expiring on March 15th at a strike of $70. Let's walk through the long put purchaser and a bearish forecast on the underlying stock. 135 is our target. We got a 30-day time frame, and we're paying $7 for that trade. If the market goes down and it gets to 140 and we're at expiration, we can sell the close, make $11 on the trade. Our gain would be $4 on the put option. So market comes in, we go all the way to the expiration. The stock makes it all the way down to our target, or close to our target, gets to almost there to 140. We could sell this position for $11, which is from 150 down to 140. So you got $10 worth of real value in this option contract, and you have $1 worth of time premium. Our gain in this scenario would be $4. And on the put side of things, if you were the seller, you would be down $4 on that position. Now, as the stock continues on down, we see we get all the way to the expiration date. Now the option contract is only worth the intrinsic value. XYZ is at 135. We sold the 150 March put for $15. Total premium received is $1,100, which is the difference between $17 or $15 and $7, or a total gain here is $8 per share, and our total loss on the seller is $8 per share. Now, on the other side of the coin, if we buy this underlying and we just get to the break even, which is 150 minus the premium paid, well, at this instance, at that price in particular, 143, the market comes down. We stop right at that break-even price. Well, in this instance, the long put buyer is at break even, and the short put writer is also at break even on that trade. And that is the price, that is the tipping point if you're putting on this option contract of the long put purchaser versus the short put purchaser. Now, if the marketplace makes a strong move to the upside, well, if we're at expiration, there's no time left, and the stock's at 154. Well, we would lose our entire premium on this option contract. If we bought this option contract at 150, the total cost that we paid is $7. That option would expire worthless, and we would be down $7 on the trade, or $700 for each contract that we traded, and we only traded one contract here. On the short put writer, you'd have the gain of $7 or $700 in this instance, because you do not have to make good on your obligation. That contract would expire worthless in that in scenario if you wrote it all the way to that expiration date. All right, so if I'm going all the way back and I look at our option contract, and we go all the way back down to the general 4 trades as far as options are concerned, and you think about buying option contracts versus selling puts. So if I'm bullish on the marketplace, I can buy a call, but I got to be careful about the amount of premium that I'm paying for my option contract. And one way that I like to look at options is that if I'm buying an option contract and I'm buy a particular strike price, what are the odds of the underlying stock getting to that strike price by that expiration date? And if I'm buying that option contract, well, I have to think about what I'm asking the stock to do over that period of time. And if you don't think it can get there, well, one of the things that you could do is sell that option contract. And one of my favorite trades to do as a beginning option trader is not necessarily buy long calls. I like to sell calls against an underlying stock that you already own. So in this instance, I'm buying a call. I'm hoping that the stock will go up. I'm going to have a right to buy the stock at a strike price. If I sell a call option, what I'm saying is I'll take on an obligation to sell my stock at that strike price. So let's pretend I had 100 shares of stock, and the underlying stock goes up to that strike price. I can get paid now for saying that you can take the stock away from me or call the stock away from me at a higher price at a later date. And that's the next place that we're going to go when we talk about the basics of options, is look at one of the more popular strategies, which is selling call options to get rid of a stock that you actually own in your portfolio. So it's a way to enhance your portfolio and bring income above and beyond any dividends that might get paid in the underlying stock for just saying you'll sell your stock at a higher price. And if I look at short puts, I think of it the same way too. If I want to enhance a stock portfolio where I want to buy an underlying stock and the market actually comes down to my strike price, well, then I could buy that stock at a lower price at a lower date and get put the stock, but I get the premium for saying I'll just buy it at a lower price. So in the option trading world, a lot of people think of speculation, buying long calls because you think the market's going to go up, buying long puts because you think the market's going to go down. But where the marketplace really originated from was selling calls and selling puts as an underwriter of the contract, receiving premium and using these strategies to enhance a stock portfolio. Sell a call on a stock you wouldn't mind getting rid of at a later date. Sell a put on a stock you wouldn't mind buying in the short term. All right. So my name is Brian Overby. I am the senior option strategist with Options Play. If you have any questions, please let me know in the Q&A box, and I'll try to address them. On X, my handle is at Brian Overby. My book is actually optionsplaybook.com. If you'd like to learn more about these strategies, just check out my website. And if you have any questions, we can try to answer them live at this point in time. I don't see a ton of questions in here. Please do put them in the Q&A box if you would like. I don't know if they're not popping up. I'm seeing people put in the questions, but I'm not really seeing what the question is. Oh, there we are. Okay. All right. First question is Options Play. Optionsplay.com is the software. It's available to everybody that has a First Trade account. You can see a lot of the actual suggestions on option contracts, as far as there's a covered call screener that will look for underlying stocks that you might want to sell calls on, that you might want to buy puts on. That is all available to you. If you type in an underlying that you're interested in, the Options Play software will actually pick out long calls, or if you want to get bearish long put options that you might want to think about trading. So as far as open interest is concerned, it is a very, okay, open interest is a real interesting question. We do got a question about it. So let me pull up a section in my book that kind of covers open interest and what it's all about. And this is called cashing out your options. So inside the presentation, we talked a little bit about what you can do. You can buy, you can exercise your option contract, meaning you can buy the underlying stock at that strike price if it's a call option, or sell the underlying stock at the strike price if it's a put option. And if we're looking at cashing out your option, the next thing that you could do is you could actually sell your option contract and close it in the marketplace, or you can let it expire worthless. And here's one of the biggest misunderstandings about option trading is that a lot of people just assume that option contracts usually expire worthless. I've heard a bad number saying like 80% of option contracts will expire worthless. And that's really just not the case. So in this section called cashing out your options, these are numbers directly from the Options Clearing Corporation. And the numbers don't change very much over the years. But most of the time, if you buy a call option or you buy a put option, 70% of the people will actually close it. In other words, I'm buying to open and then I'm going to sell to close. Only 11% of option contracts actually get exercised, and that means about 19% actually expire worthless. And that's not bad if you are on the sell side of things, right? So we talked about covered calls, which is going to be our next big event, and we're going to highlight inside the software how to find good covered call trades on underlyings that you want to trade. But in this instance, 19% of the time, option contracts expire worthless. So what's the moral to the story? Most of the time, option contracts are bought to open and then sold to close, or they are sold to open and then bought to close. An option contract is not a hot potato that it's got to land in somebody's hands, and at expiration, somebody's going to get stuck with this option contract, and it either expires worthless or you actually get money on that option contract. So that's not how it works. Open interest goes along with that, and open interest tells you how many option contracts actually exist on the underlying based off of the volume. So we saw an instance where there was, and I think this is one of the questions that we received, we saw where the volume was 3. Well, let's take it from here, okay? So here we see a volume of 5 contracts, and we see an open interest of 15. Now, this means that tomorrow, on a very small limited basis, we could see either 20 contracts, right? Let's say it was just one trade that was sent to the floor. And if they were all opening, this number would go up to 20. But if those 5 contracts in that volume were marked closing, this open interest would go down by 5 contracts, and tomorrow we'd see 10 in the open interest. This number does not change during the trading day. It only changes overnight. So, do I want open interest in my option contract if I'm trading it? The answer is yeah. You'd want more people interested in your option contract than having less people interested in your option contract. Very straightforward. All right. Yes, the webinar will be available inside the First Trade platform with the other videos that you have. Okay, so what is a covered call? Well, that's going to be Manny. That's going to be the next seminar that we're going to talk about. And inside my book, even I talk a little bit in the basics, in the rookie's strategy about the covered call, and it kind of highlights a simple way to get your feet wet trading options. You own a stock. If you get the right to trade options, which you do have to fill out an application saying that you want to trade options, and you will be assigned what types of trades you'd be able to do in your account through the options trading application process. Okay, so I got to realize that we need to bring that up. But one of the simplest things that you can do, most option traders own at least one stock, is sell a call option on a stock that you already own, saying that if the stock goes higher, you can call the stock away from me. And it's much different than just buying an option outright, where we showed you where time premium is such a big issue in the movement of that underlying stock and trying to get the timing right with the movement of the stock. You sell a call, if it goes up and it gets called away, that's great. If it doesn't, then you just collect the premium. So I like this as a strategy for rookies, and I highlighted that inside my book, which this is the book's website, called Covered Calls. Okay, so that is correct. Selling a covered call. Wes, if I buy a call option and it's in the money at expiration, but I don't exercise it, will I make money from it, considering it's in the money, or does it have to be exercised for me to realize the profit? Okay, so this is great so if I go back to, I'm just going to type in cash here. So if I buy an option contract, and now this is one of the biggest things that you need to understand as a basic option trader. If I buy an option contract and it gets in the money, and I'm buying a call option, which is Wessam is mentioning a call option, do I have to exercise in order to make money? The answer is, in general, no. If I'm cashing out my option contracts, most of the time I'm going to sell that option contract. And just think of the rationale that's behind it. Let me grab a little bit of water. If you buy the option, you're probably buying the option because you didn't want to pay for the stock. If you exercise a call option, you will buy the stock at that strike price. And if you do, you're going to be spending a lot of money to buy that stock. And then you can decide, I can sell it right away, or I could hold it, I could do whatever I want to do. But more often than not, if I bought the call option and it goes up, why not just sell it? Why not just get out of the position and don't deal with the stock at all? If I was correct on my forecast, why put up all the capital to buy the stock and then just turn around and sell it again? So most of the time, you will just sell the position. If I go all the way to the expiration and my option contract is in the money, in other words, I end up with real value in my option contract called intrinsic value. If I do that, the Options Clearing Corporation will exercise on your behalf. And you may or may not have a profit. You're not 100% sure. Just because it's in the money doesn't mean that you got to the break-even point on your option contract. But the Options Clearing Corporation, if you are 1 cent in the money and you ride it all the way to expiration and you just fall asleep, they're going to exercise on your behalf, especially if you have the capital in your account to pay for that underlying stock, and you're going to end up owning stock. So one of the things that you don't want to do is just buy an option contract and ignore it, unless you really want to buy the underlying stock. If it has real value, the options clearing corporation will exercise on your behalf, and then you would be in this piece of the pie, if you will, in the 11% of people that actually exercise their option contracts and either buy stock or sell stock. And no, so in short, sell it. If the market goes up, you can sell it and you can close it and you can get out. Okay, so I had a question to go all the way back to the bid and ask. If we look at the bid and the ask inside this chain on Apple, and I'll pull up the slideshow. Well, the bid price is where I'm looking to sell at, and the ask price is where I'm looking to buy at. And it's not much different than the stock. If I'm buying Apple and I'm going to go out and say I want to buy 100 shares of Apple, in this instance, I'm going to pay $189.82. $189.82. And then I instantly decide that, oh, I don't want Apple, and I sell. Guess what? I'm going to lose a penny. I'm going to get $189.81. Now, the market is making a market in that underlying stock. Everybody that is on the buy side and on the sell side is all coming together to represent what's the buy price for the stock and what's the sell price for the stock. That's very true in the options marketplace, and there are a plethora of different options that you can trade. So the bid is the sell side if I'm selling this option contract, and the ask is the buy side. Now, in the options trading world, it's very possible, and let's look at this put option over here, because we're just talking about a very short-term option. It's only got 1 day remaining to expiration. You see that this option contract is going out worthless, right? So if I bought this and the market went up, well, I bought a put, I want the market to go down, and it goes up. Okay. So in this instance, if I bought this and let's say I paid $1.40 for it or $140 for it, I might not be able to sell it because it's expiring worthless. There's no benefit to owning the 177.50 strike put with the stock at 189 with only 1 day remaining. So you see the bid is 2 cents and the ask is 3 cents. So keep that in mind, that there might be a situation where it's just not worth selling it for anything because the market has moved against your position too much if you are long option contracts. But it's just like with the stock. The ask price is your buy price. The bid price is your sell price. All right, I'm reading a long question, so give me a second here. Okay, so I guess the hesitation is from an anonymous attendee talking just about I've owned stocks. I've owned stocks and bought and hold stocks and was terrified to trade options. Well, once again, if you go back and you own a stock that you're willing to sell, a good place to start is just selling covered calls, which is going to be our next event. If I own a stock and I'm willing to sell it at a higher price, I can sell a call saying you can call the stock away from me. And that's how you can get your feet wet. If you want to buy an option contract, just do it on a limited basis. Like the anonymous attendee mentioned Bitcoin for one of the stocks, which they have ETFs that track Bitcoin now. And then another stock, NVIDIA, which obviously that stock has done really well. The way that I would approach it, let's talk about NVIDIA, NVDA, is if you were going to buy 100 shares of NVIDIA, buy one call option. Don't overdo the leverage factor, or maybe buy 2 call options. And think about what you're asking the underlying stock to do if you're buying that option contract and where the break-even point is. So you just want to be cautious with the leverage. You don't take all the money that you would have bought to buy or spent to buy 100 shares of NVIDIA and buy as many call options as you possibly can. That's overdoing the leverage thing. You can actually buy Nvidia. Like at this point in time, Nvidia it's been all over the place, just like a lot of the stocks since the beginning of the year. Buy Nvidia, pay a few $100s to control 100 shares of stock. And if the stock does go up, well, you could exercise and then buy the stock at the lower price later, or you can just sell the call option outright. It's a way to actually dip your toe in Nvidia without having to put up all the capital to buy 100 shares of that underlying stock, or 50 shares or 10 shares, right? You can use options as a way to hedge yourself to say, I'm a little bit worried that the stock may take off, and I don't want to spend all the money to have all the risk on the underlying stock. I can actually buy a call option and reduce my risk because I'm going to buy one call option as opposed to buying 100 shares of stock. I think I got there at the end, right? So it's all about the amount of leverage that you want to do. There's no reason to be scared jumping in. Just like owning stock, you can obviously lose money if you trade options, but you can lose money if you trade stock too, right? The same scenario. Just be very careful with the leverage scenario. Okay, and assume I want to keep the shares I own. I'm interested in using options for income. Okay, options for income means that I'm either selling a put to buy the stock at a lower price, or I'm selling a call to sell my stock at a higher price, stock that I already own. That is one way that I can bring in income above and beyond any dividends that the underlying stock may pay. And that's where I might, and we're going to go down that road. We're going to talk about covered call selling, cash secured put selling, and then the next event is actually called the wheel, where we sell a put to buy the stock and then own the stock and then sell a call to get rid of the stock, to sell the stock at a higher price. And that is actually referred to as the wheel strategy in the options trading world. And that's where our next steps are. We're going to start off with covered call writing, which I even already mentioned inside my book. I have a highlight as one of the first places you might want to start if you're a beginning option trader. And selling a put is also not a bad way to go about it. But once again, you got to get approval to do these trades. You can't just start trading options. You need to talk to First Trade and make sure you get the option trading application all filled out and you get approval to do the trades before you can place them. How would a trader arrive at an optimal strike price or expiration of an option contract? Joe, you know what? We're going to cover that. We're going to cover that in the next event on covered call writing, and we're going to show you how the options play platform, which you have access to, will help you choose those strike prices. Oh, thank you, Manny. I appreciate it. I think that's going to be it. I actually got to all the questions, which is very rare for me to be able to get all of them covered. And we're right at time. So thank you for coming, everyone. We'll see you for the next event that is going to be covered call writing. And one of my favorite strategies to do. It's one of the, I think, most used option strategies. A lot of people think that options are used, once again, for leverage. And you want to buy a call because you want to leverage the fact if you're correct on the forecast on the upside, or buy a put on the downside. But probably the most popular option strategy I've ever seen used is selling covered call options on stocks that you own. And I've been doing this now for 25 plus years. So thanks for coming, and I'll put my information up and we'll leave it there. Trying to get there. There we go. All right. Once again, Brian Overby. Follow me on X. Handle is at Brian Overby. And please check out the optionsplay.com platform. Thank you, everyone, for coming, and we'll see you soon.